2020, baby. Yeah. Got the color, got the put. I can make the money both ways, always. I can buy the whole chain, go away. Got a lot of love and throwing no shit, no games, small change. I just made my own band.
Hello, people. Well, I was supposed to make a return next week, but then I just realized January is over, and as part of my journey, I do these monthly recaps. So it's time to do a monthly recap of how the portfolio has fared from October until the end of January. So over the period, we've closed around 66 trades. Of these 66 trades, 73 of them have been profitable. So our win to loss ratio stands at around 2.7 to 1, which is really good. And on average, our wins return around 8%, whereas our losses lead to us losing around 7%. So again, the win loss ratio, it's in our advantage. Our portfolio also seems to hold trades for a reasonably long time. So on average, we're in trades around 20 days. So very good numbers there. Our Sharpe ratio is also slowly increasing. At the end of December, it was around 0.3, and now it's around 0.52. So technically, you just have to think of the Sharpe ratio as the amount of return we get for each unit of risk we take. So currently, for each unit of risk we're taking, we're getting around 0.52% of returns. The maximum drawdown is still the worst we got in October, and it hasn't increased, which is a good thing. So we almost went into a new drawdown this week, but we were able to recover on Thursday, which means that for now, the 8% drawdown is still the max drawdown. When compared to our benchmarks, we're doing a pretty good job. So again, return to date is around 12%, which is twice as large as the S&P return over the period, almost twice as large as the Nasdaq return, and we are highly correlated with these two portfolios, mainly because for now the portfolio has been long only. So now that we're going to introduce a short component, we expect this correlation to slowly go down. So if you're more of an academic, you will be thinking in terms of what is the covariance between our portfolio and these benchmarks. So our beta with respect to S&P 500 is on the low side, around 0.8. Similarly with the Nasdaq, around 0.8, which means we're producing alphas with respect to these two portfolios. So with respect to the S&P 500, the alpha is around 2%. With respect to the QQQ, the alpha is around 1.8 to 1%. Okay, so I would say I'm very comfortable with where the portfolio is now. We've been doing a good job, right? So in October, our benchmark, we did better than our benchmarks in terms of return, even though we are all in a negative. In November, the benchmarks beat us, but in December we did beat the benchmarks, and in January we have beaten the benchmarks again. So looking at this, one would expect us to continue beating these benchmarks going forward. And with the introduction of the slides shortened to reduce the risk of the portfolio, we should be doing that with a better Sharpe ratio. So tune in next week to see how the artificial intelligence portfolio performs going forward. If you're on eToro, consider following the portfolio with a small $200 investment. Over time, if you see the portfolio performing, you can start channeling some savings into the portfolio. And by the time you retire, you should expect to have a nice nest egg, which should be able to take you through retirement. That's the whole plan with the portfolio. Keep it consistent, keep the risk low, give people an alternative in which they can invest their savings and earn something beyond zero. Because let's face it, most savings accounts today give you a return that is less than zero or just a couple of basis points above zero. So, hope you enjoyed this video. If you did, be sure to smash that like button. If you haven't subscribed, make sure to subscribe and hit the bell button. Thank you for tuning in. See you guys again soon.
Make $100 off a phone call, now that's a telethon. Benjamin's Jefferson, YOLO to a ghetto spread. Yeah, you know I've been it there. Who's been like a Trinidad? I'm moving like a president.